Welcome to the Daily Fiscal Pulse. We're looking at the 19th of May, 2026, which wraps up Tuesday's trading activity. Keep in mind these are settled figures, not real-time data, as we break down what happened. Let's start with what's capturing market attention at the moment. Equities and broader market movement are front and center. The prevailing narrative centers on traders now seeing next Fed interest rate move as a hike following inflation surge, and that's driving the price action we're seeing. Of course, market narratives tend to shift. The actual flows tell a more reliable story. Looking at fiscal transfers, we landed at $2.6 billion for the session. Tax receipts did the heavy lifting, bringing in $9.6 billion. On the surface, there's nothing particularly remarkable about that picture. What's interesting is how the S&P mini futures are holding their own relative to the underlying fiscal pressure. ES closed at 7,378, staying comfortably above the 20-day moving average of 7,317. The 20-day trading range sits at roughly 461 points wide. Price action remains resilient despite the fiscal headwind we're tracking. Zoom out and you'll see flows have definitely picked up. Over the last 5 days, government spending is averaging about $20.1 billion daily. That's notably higher than the 20-day average of $10.6 billion. More cash flowing through the system means more liquidity seeping into household accounts and eventually into equity markets. Year-over-year comparisons reinforce that pattern. Through this point in the fiscal year, spending has totaled $913.2 billion, roughly 20% below the same window last year. That's a substantial pullback in fiscal support, and it does carry implications for liquidity conditions overall. From a tactical positioning angle, the fiscal backdrop isn't signaling a clear directional bias right now. Our conditions gauge sits at -1. History offers perspective though. We've encountered this exact type of setup multiple times before, and even with tighter liquidity conditions, the S&P has averaged around plus 0.7% over the following month. Markets don't necessarily move in lockstep with liquidity flows. They frequently grind higher despite softer conditions. One thing worth monitoring closely is margin debt, which is currently sitting at the 100th percentile. That's elevated territory. Historically, when margin hits these levels, it's functioned more as a caution signal than a bullish indicator. Looking ahead at what could shift the dynamics, the 20th of May brings the Social Security Administration payment cycle, which falls on the third Wednesday of the month and can influence near-term flow patterns. The next significant Treasury coupon interest payment window arrives around the 15th of May. Right now the fiscal setup isn't tilting decisively in either direction. The scheduled cash flows we're expecting will be the key factor in determining whether that changes. That's what we're monitoring heading into tomorrow's session.